Yeah, thanks, Dorothy. All right. So we're looking at risk-adjusted discount rate. I don't know which number it is, but concept is what matters most. So we talk of risk-adjusted discount rate, RADRI. It uses a higher discount rate to reflect additional risk in a project. Riskier projects are discounted more heavily, reducing their net present value. So riskier projects will have a higher cost of capital. Yeah, the moment the cost of capital is very high, then automatically your net present value will really reduce. Advantages, it is simple and widely used and even understood. It aligns with the required return for risky investments. Yeah, in this case, here limitations, subjectivity. Yeah, I mean, how will you be able to say that this project is more riskier than the other one? And if it's more riskier, they're going to give it 20% cost of capital. So arbitrary adjustment of rates. Some rate applied to future cash flows, regardless of varying risk, same rate. That we have a 20%, being in this case here, the rate to be used to discount all future cash flows. And yet we know that as time goes by, cash flows in this case will become more riskier. So we need to keep on increasing. But we're saying in this case, as a disadvantage, this method assumes that all cash flows in the future will have the same risk. With your permission, I'll be able to go to a question directly. And I'm looking at this illustration, which of course I'll be able to share the handout with you in a few minutes. So you're told the finance manager of Biashara Limited has suggested that 3 projects in B below should be analyzed using the risk-adjusted discount rate. The finance manager has developed the following model to calculate the RADRI for each project. So we have RADRI being equal to risk-free rate plus a risk index, yeah, capital RI, into KO minus RF. Is there anybody who has ever seen this kind of an equation anywhere? This equation is similar to something that you guys must have even covered in a class. It's quite similar to something. RADRI is very, very similar to something. Is there somebody who has ever seen an equation that is very, very similar to this that you are seeing here? Which starts with, yes, CPFM. And that is why, at times, ladies and gentlemen, they write RADRI, yeah, formula as CPFM formula. Yeah, so in this case here, we are given an example where the risk-free is 10%, returns of the market is 12%. They have given us 3 projects, of which we have beta X 1.8, beta Y 1, beta Z 0.6. The company's cost of capital is 15%. So we are required, they must have forgotten, it's here, required, they want us to provide the risk-adjusted discount rate for each project. There are 3 of them. You can see they are here. There are 3 of them. They are here. Project X, Project Y, Project Z. So, ladies and gentlemen, let's tackle first of all the first requirement where they want us to give them the RADRI. How do we get this RADRI? This is quite common in your exam. How do we get this RADRI? Very easy. Yeah. So to get this RADRI, the examiner has given you a formula. I know, of course, in CPFM, get CPFM, don't write this. We normally take risk-free plus ERM minus risk-free multiplied by beta. Yeah, beta of a security. Yeah, that's what we do. Yeah, CPFM returns. We normally start. Ladies and gentlemen, remember under CPFM, if I could just give you some highlight. There is nobody who is rich in this world who does not diversify. For you to be rich in this world, meaning that, for example, even if you have to become a little disabled here and there, yeah, your life has to go on in terms of your incomes. So for that to happen, then diversity is key. And of course, most importantly, rich people must always have risk-free assets. So you must always begin with risk-free government bonds, treasury bills, etc. And then now we have the market portfolios, market securities. Market securities are risky. But of course, they come up with a premium, a higher return. So normally what we do, we normally take the returns from risk-free, we add what we call the risk premium. So because of the risk premium, then we must multiply outside here with what we call the risk index. Risk index is, in this case, is what we are calling beta. Now remember that your examiner has not told you to use CPFM, but he has just written for you a formula that you can use to get RADRI, which is risk-adjusted discount rate, which according to the examiner has told you to use risk-free plus capital RI, risk index, which is the same as this beta. If you brought this beta here, same, you get the same answers. So we have in this case here plus risk index into, they are calling this core. And you shall be able to see what this core is, minus risk-free. Yeah, like that. It's good you get used also to this formula because as you'll realize, your examiner in your past papers, at times you can write it this way. So you have to follow what the examiner wants us to use. So I project my screen again for you to be able to see what this examiner wants us, ladies and gentlemen, to use. So this examiner wants us to use this formula of RADRI. RADRI stands for risk-adjusted discount rate. This one here. Yeah, RADRI. And you can see RADRI is a risk-adjusted discount rate for project J. Then we have RF for risk-free rate. Then we have in this case here, we have risk index for project J. This RI, risk index. 𝐄𝐄𝐒 is the cost of capital for the whole company. Cost of capital for the whole company. And the cost of capital has been given as 15%. So here, you know, CPFM will use returns from the market. Here they want you to use 𝐄𝐿, which is cost of capital, in this case here, which is 15%. So they want us, number one, to give them the RADRI for each of these projects. So we start with RADRI of project X. So right there, RADRI of project X. So in this question, have you been able to see the risk-free rate? So this project X, remember. Have we been able to see the risk-free rate, ladies and gentlemen? In this question, do we have the risk-free rate? Oh, yes. So the risk-free rate, ladies and gentlemen, in this very question, which I'll be able to share with you as we continue with the class, yeah, they have told us the risk-free is 10%. Yeah, so 10% plus the risk index, which is the same as beta for X. So you can see beta for X here, it is 1.8. So 1.8 into the cost of capital of the company. Cost of capital of the company is given here as 15%. 15% minus risk-free, which is 10%. So is there a good student who will be able to give me this RADRI for X? For the students who have just joined us, RADRI stands for risk-adjusted discount rate. Whenever you have projects which have different risk profiles, yeah, one could be in Kisumu, another one in Mandera, another one wherever, yeah, even abroad. So you have to evaluate the risks. And then now in this case here, you use different costs of capital known as RADRI, risk-adjusted discount rate, to discount. So in this case here, we have somebody telling us that this is 19%. Other students, are they able to get this 19%? Other students, are they able to get this 19%? Other students, are they able to get this 19%? Yeah, Peter has also gotten it. So please, using the same approach, go ahead and give us RADRI for Y. So remember, this 10% will not change. Risk-free doesn't change. The risk index, the beta for Y is changing. And they've told us it is 1. Cost of capital is 15%. Then we have in this case here 10% risk-free. Yeah, I can confirm, ladies and gentlemen. Yeah, it's continuation. You could have been fair, sorry. Sorry for that. Let me see. Yes, I will be able to give you the handout. Yes. Just now I'll be able to save and then I give it to you. Yeah. So remember, ladies and gentlemen, in this case here, we have been given the risk index for Y. It is 1, which is the same as beta. And for Z is 0.6. So some ninja is already giving me a figure here. They're giving me 15%. Great. And then now we have Radri. We have Radri for Z. Risk-free is the same, plus 0.6 Z. Yeah, for Z is 0.6. Yeah, core does not change. This doesn't change. So then this one will end up giving us what figure? Yeah, so somebody is telling me that Mwalimu, this is 13%. 13%. So number one, this has been taken care of very well. This has been taken care of very well. So are we okay with Radri computations? Radri computations. So the examiner should not confuse you with beta and risk index. Remember, beta is used to measure systematic risk. Beta is the risk index for systematic risk. Yeah, so automatically it means that our projects here have got different risks. So these are the cost of capital we shall be using to discount cash flows of our different projects. Because you see, all the other methods in this case here, what do we normally do? We have a blanket-wide cost of capital. So we say it's 15% for all projects. And of course, projects have different risk profiles. Now we go to number 2 of this question. So number 2 of this question, they have given us the cash flows for each project, right? They have given us the cash flows for each project, and then they want us now to give them NPV for each project using the Radri. So let's start with project X. Please copy the cash flows of project X. So we handle the project separately because, of course, they have different risk profiles. They have different risk factors. So we start straight away there with the project X. Project X. So project X, I can see time. Yeah, 0, 1, 2, 3, 4, 3, 4. And then I can see my cash flows. I can see my cash flows. So cash flows of X, X alone. So cash flows of X, I can see 15. Yeah, I would rather we cut those zeros, eh? Yeah, let our figures be in millions. So I can see 15 times 0. Then I can see 6, 6, 6, 6. Yeah, for project X. And remember, project X, we have its cost of capital. So in this case here, we are using, 19%. We are using 19%. 19%. So there are 2 ways of going about this. One of the ways is to assume, ladies and gentlemen, that these are independent cash flows. We assume like they are irregular, and we use at 19%. We assume they are irregular. Let's use PVF, and then we shall be able to, method 2, assume, not assume, but I mean, we take them as they are, that they are annuities. We use PVFA. So let's use PVF first, and then we compare notes. So let's use 19. The weight is, yeah. So we have, ladies and gentlemen, our table. So first of all, before I even remember the formula, I will always ask myself, in the table, in our discounting table, we have like now 19%. You can see 14, 15, 16, 18, and then they skip to 20. So 19% is not there. So if it's not there, then I will be able to use the formula. The formula for getting PVF. We know the formula for getting PVF, ladies and gentlemen. This is the easiest thing. So I will always use, in this case here, 1 plus R, and because I'm discounting, I can't use the one of compounding positive n, so I will use negative n because I'm discounting. So because I don't have 19%, I have to compute them slowly. Fortunately, R is the cost of capital, and in this case here, 19% is now what we shall use for X. So then this will be 1 plus 0.19 raised to negative n. So it means that this will be 1.19 raised to negative 0 times. This will be 1.19 raised to negative 1, 1.19 negative 2, 1.19 negative 3, 1.19 negative 4. So then in this case here, give me 4 decimal places. Give me 4 decimal places. Yeah, 4 decimal places. The first one, of course, is 1. The first one is 1. Yeah. The first one is 1. You relax. I'll use both methods. Just relax. I'll use both methods. They're the same. They're the same. So we have here 1. So what about 1.19 raised to negative 1? 0.8403. 8403. How about 1.19 raised to negative 2? 0.7062. How about 1.19 raised to negative 3? I hope you know how to raise. So 0.59. 0.59. 34. And then the last one, thank you so much. The last one, raised to negative 4, 4987. 4987. So then come and give me here discounted cash flows for this X. So discounted cash flows for X, what do I do? First one, I'm taking these cash flows times the discounting factors. So minus 15 times 1, this gives me minus 15 because I'm investing. Yeah, please give me many decimal places. 8 or rather 6 times 0.8403. Yeah, 6 times 0.8403. So according to M, we're getting 5.0418. 5.0418, sorry. Yeah. Then we go to the third one. So 6 times this. What figure are we getting? It's 2,372. Decimal there. And then we have 6 times this. 35,604. $29,922. I've seen your questions. I'll be able to address all of them. Now from there, come and give us the total discounted cash flows. Add them. Add them. Add them. So we have here minus 15 plus this, plus this, plus this, plus this. Which question are we doing? We have a question in our handout here. Which I'll be able to share with you very fast here. This is the question that we are doing. So now we are getting NPV for each project using the RADRI. Using the RADRI, and I'll be able to show you. I'm sorry, most of you have come in late. You have come in late. Just give me a few minutes. I just finish this, and then I come back. Okay. So they're getting here, ladies and gentlemen, 0.8316 positive, Because it's positive, the project is viable. The project is viable. Now let me address your questions one at a time. The first question that I was asked here is why, Mwalimu, are we using PVIF? And yet you can see that project X is yielding constant cash flows. Yeah, you're right. So mention that method 2, because I can see 6666. Mention that method 2. So under method 2, for project X, first of all, it's always good for you to be aware of the 2. So method 2, Yeah, Peter Munyeri. Oh, you're not waiting for us to copy. We shall overcome. The sound, today you seem to have quite many issues. We shall overcome. I'll be careful now. Now, so it's Project X. So Project X, I can see it has an annuity of 6, yeah, per annum for 4 years. So in this case, I can come and straight away get net present value by taking the annuity, yeah, times PV present value interest factor of an annuity, and then I subtract initial outlay. We subtract initial outlay. So NPV will be annuity times PV, yeah, because 6 is an annuity figure minus initial outlay. So let's compute this PV. Remember, the formula for getting PV, if you remember very well, we normally say amount equals principal into 1 plus R raised to power n. It is compounding. This is compounding. When they tell me to discount, assuming this is not there, when they tell me to discount, they want me to use this PV for 1 shilling. So this P is not there. So PV, I will copy exactly the same, but because this is discounting, I'm not compounding, I put this as negative n, like that. This is PV. Anytime they tell me to write the formula of PV for annuities, I will first of all remember this formula. And once I remember this formula, then I will be able to come here and write PV. So PV will be 1 minus this smaller formula. 1 minus this smaller formula. The smaller formula is 1 plus R. Yeah, everything to be divided by what here there? R. So this is present value, interest factor of an annuity. I would want you to copy that. So it is 1 minus 1 plus R raised to negative n. So then in that case here, my PV will be 1 minus the project we are handling. It has a risk of 19%. And we are going to enjoy this cash flow for 4 years. The 6, n is 4. And then we divide everything with this same R, which is 0.19. Sound, They're saying that the sound has a problem. Is that true? Are you guys able to hear Mwalimu? Are you guys able to hear Mwalimu very well? Are you able to hear Mwalimu very well? Clear on my end. What could be the problem? Not clear. Keeps breaking. Not so clear, sorry. Not clear, not clear, not clear. Maybe I should shout a bit. Maybe I should shout a bit. Maybe I should shout a bit. Breaking. Let's see how far we go with it. Let's see how far we go with it. Has it improved now? Any improvement? Any improvement or nothing? Mic problem, Mic problem, mic problem. Mic problem. It happens here. So I'll be able to change, I'll be able to change, but for now, let me just shout a bit, I know where the problem is. I know where the problem is. I'll be able to change, don't worry. So then can you kindly go ahead and give me this PV far? So PV far here, yeah, please say 1 minus, open brackets, 1 plus 0.19, you close. Then you say raised to negative 4 equals, whatever answer you get, you say equals. You divide by 0.19. So in that case, here I'm being given PV of 2.6386. 2.6386. So all of us, are we able to get this answer? Are we able to get this answer, all of us? Are they able to get this answer, all of us? Yes, thank you very much. Then come straight away here and give us our net present value. So our net present value here will be annuity. The annuity for project X is 6 times our PVFA, which is 2.6386, minus the initial outlay for this project, which was 15. Initial outlay was 15. Remember, for this project, the initial outlay is 15. We cut these 3 zeros and we are using now shillings millions. So initial outlay is 15. Now, so another student has asked me, how did I get this 19%? Remember, the method we are using is called RADRI. RADRI. We are using a funny method here known as RADRI. Yeah. And this RADRI, we shall always compute the cost of capital for each individual project. Yeah. And then, of course, the examiner has given you the formula for getting this risk-adjusted discount rate. Yeah. So the RADRI has been given. So RADRI has been given. It is risk-free plus KO. Not KO, but yeah, risk index. Yeah, so we have here risk index. Yeah, and then we have here KO minus, in this case here, risk free. So this formula, of course, will be given to you. It's very, very similar to CAPEM. Yeah, so we have here RADRI. Yeah, and then you can see RF is risk free. Then we have risk index for project J. Yeah, and then we have risk free. Yeah, this has been given. And then the cost of capital is 15%. Is 15%. All right. So then let's compute this RADRI for project X. So for project X, what have they told us? So we have the risk-free is 10%. So risk-free is 10% plus risk index is also known as beta. Beta for project X is 1.8. Into the cost of capital for the whole project. Cost of capital is 15%. Minus risk-free. Risk-free, ladies and gentlemen, which happens to be 10%. Which happens to be 10%. Yeah. So this is what they did to get 19%. So I hope that is helpful. What I'm wondering, we have done project X using 2 methods. Have they been able to give us the same answer? Have they been able to give us the same answer? Yeah, we got the same answer. We got the same answer. Now, with your permission, at least I'm trying to respond to the latecomers. I hope they have been able to also copy this down. And if that is the case, let's go to project Y. Yeah, why am I using beta? It's because, ladies and gentlemen, remember, you must have been told when you did CAPEM, you are told that beta is a risk index, which measures systematic risk. So your examiner will either call it risk index or he calls it what here, beta factor. Yeah, interchangeably. So it is either risk index or beta. So I hope I've answered your question, Peter. Yeah, great. So then now we go to project Y, using in this case here RADRI. Now, for the sake of the latecomers again, I would want us to compute RADRI for project Y. We start from there. Let's compute RADRI for project Y. So do we have risk-free does not change? The risk-free will be 10. The risk index for project Y, I can see it here, beta Y, it's 1. 1 into KO is the cost of capital of the whole farm. The cost of capital of the whole farm has been given as 15%. So this is 15%. This is 15%. 15% minus risk-free. Risk-free happens to be what here? 10%. So can someone in this case here give me the RADRI for project Y? So give me the RADRI for project Y. Anybody who is able to do that? RADRI for project Y. RADRI for project Y. 15%, isn't it? So 15%. So 15%. So all of us up to here now, are we okay? Are we okay up to here somehow? I know my microphone has a problem, but at least you're able to follow before I change, because I must change. I must change. I must change. All right. So then what I want you to do, now that you've been able to get, ladies and gentlemen, the RADRI for project Y, go ahead and discount the project's cash flows. You can see in this case here, the cash flows of project Y are given here. I want them to be in shillings millions. Yeah. So right there, project Y cash flows. So we have time. So we have 0, 1, 2, 3, 4. And then I have here cash flows, project Y. I can see 11. Yeah, negative because I'm investing there. Year 1, I get 6. Year 2, I get 4. Year 3, I get 5. This I get 2 like that. Now remember, this one, there is no way you can use PV for. This one, you can only use PV. PV. And unfortunately, project Y, we know that we are using 15%. So before I start computing the PVs for each year, always go to your table. See whether your table has 15%. Of course, for time 0, I know PV is always 1. So let's go to our table, and then we get to see whether our table has this 15%. Let's see. Yeah, it is here. It's here. Yeah, it is here, ladies and gentlemen. I can see 15% very clearly. 3 decimal places. Yeah, I can see 15%. 0.696. It is here. Not very clear, but we shall overcome. 0.696 under 15%. 7561. 7561. And then we have in this case here the next one under 15%. 6575. 6575. And then, ladies and gentlemen, we can see the next one, which is 0.4972. 49. I think this is 86. Sorry, 86. Yeah, 86. Yeah, 49.72. Great. 49.72 here. And then this is 0.86. Sorry. Yeah. So they give me the discounted cash flows of Y. Thank you so much, Derek. Yeah. So give me the discounted cash flows of Y. So discounted cash flows of Y, what do we have? This will be negative 11. Please talk to me. Negative 11. Talk to me. Give me answers. Talk to me. Yeah, I will be able to give you better sound in a few minutes from now. Yeah, 5.2176. 5.2176. And then somebody is saying year 4 is incorrect. There's a ninja saying this is incorrect. 3244. Yeah, with a decimal there. $32,875 with a decimal here. And then there's a ninja who is saying this is incorrect. So you have to check this out first. Year 4, I'm being told is 0.57. 0.57. I don't know how I read it. Year 4, I'm being told is 0.57. 5718. Sorry for that. And then the final answer here. Can somebody give me the final answer? Can somebody give me the final answer? 11,436 with a decimal there. So come and give me net present. This will be net because we have a negative initial outlay there. So now you add up everything. 16,731 with a decimal there. So in this case here, this is positive as well, viable. Positive as well, viable. So of course, I know you are struggling with my poor microphone, but somehow, are you able to follow somehow? Are you able to follow what you're doing somehow? Great. So then we go to project Z. And once you finish writing up to here, please put your thumbs up like this. Once you finish writing, put your thumbs up. Once you finish, put your thumbs up. Thank you so much. So we go to Project Z. Project Z is straightforward. So Project Z is very straightforward. So Project Z, what do we have here? As I share this handout with you. So Project Z, ladies and gentlemen, first of all, let's get the RADRI for Project Z. Let's get the risk-adjusted discount rate. Risk-adjusted discount rate for Z. How do we do that? We have a formula. The RADRI, it's called risk-adjusted discount rate. We have a formula. So the RADRI, in this case is risk-free plus risk index into cost of capital minus risk-free. So remember, the risk-free doesn't fluctuate. Risk-free is always constant, and the risk-free has been given by the examiner as 10% plus the risk index for Z. Risk index is the same as beta. Beta for Z is 0.6 here. Then we have the cost of capital of the fund is 15% minus this 6%. No, risk-free is 10%. Sorry for that. Risk-free is 10%. So then are you able to give us this RADRI for Z? Are you able to give us this RADRI for Z? Somebody is telling us that it is 13%. Then use it to discount cash flows of Z. Use it to discount cash flows of Z. So we have here our cash flows of Z. Yeah. So cash flows of Z, use it to discount cash flows of Z. I want to rub this. So let's use it to discount cash flows of Z. So we have here cash flows of Z. Yeah. So we have here cash flows. So we have here zero, mean time. So 0, 1, 2, 3, 4. Then we have cash flows of Z there. So the first one at time 0, ladies and gentlemen, at time 0 Z is quite not a very heavy project. So project Z, ladies and gentlemen, I can see it's 19 bob in millions. So 19. Yeah, it's an outflow because today we are investing today. Then we have 4, 6, 8, 12. 8, 12 like that. So then you come, of course, ladies and gentlemen, you'll bear witness with me that these are irregular. They're irregular, they're fluctuating. So I'm going to use PV, present value interest factor, at 13%. At 13%. So before I start showing the examiner that I know the formula, first of all, I'll beep through my discount table. We beep through the discount table. So the discount table, let's see whether it has 13%. Let's see whether it has 13%. If it has, it's a hooray moment for us. Oh, it doesn't have. You can see 12, 14. Not a worry at all. I'll be able to get everything, ladies and gentlemen, because I know the formula. So this will be 1.13 raised to negative 0, 1.13 raised to negative 1, 1.13 raised to negative 2, 1.13 raised to negative 3, 1.13 raised to negative 4. Yeah, the table is always provided, but you're always better off knowing the formula. So we have the first one is 1.8850. 7831. Thanks, Peter. Thanks, Margaret. Always a talk. Then we have 6931. Then the last one, it will be 1.13 raised to negative 4. 6133. So 0.6133. So then come and give us discounted cash flows for Z. So this will be negative 19. The others I don't know. 4 times this 8850. 3.540. Yeah. Then we have 6 times this. 4.6986. Then we have 8 times 0.6931. Then we have 12 times this. 7.3596. So please come and add for you to give us net present value. 2.143. Like that. They are still viable. So they never told us in this case here to compare the projects and perhaps pick the one that has the highest NPV. All of them are viable. If you can afford, if there are no capital limitations, then invest in all of them. All of them are viable, yes. They are viable. So then, ladies and gentlemen, with your permission, I will be able to go straight away to the last area of this, known as decision trees. Quite a nice area for students. Decision trees. So I don't know, I think my microphone maybe has a battery problem. Yeah, Lincoln is asking a very good question. So I think my batteries have a problem for the microphone. So now we have to decide. Do I teach you using this bad microphone, decision trees, or do we postpone this class? If you're able to hear, we continue. If you're struggling, you can say because these decision trees are very, very important, let's pick up this class maybe tomorrow, whichever day. We continue. They're able to hear now, right? It's clear. Great. Thank you so much. They are able to hear. Let's continue. Thank you so much. Great. Great. Let's continue. Great. And then, of course, I'll shout a little bit in a way that I'll not scare the neighbors. So decision trees are very, very good because they're applicable in AFM and in AMA. Okay, somebody has a problem. Which project should be all projects? So long as a project has a positive NPV, it will be pursued. Not unless you're told there are capital limitations. Yeah. So Joanne has a problem. Can somebody in this case here answer Joanne? You see, Joanne PV should be used whenever the cash flows you are going to get fluctuate. So this year you are getting 10, next year you're getting 12, like the project that you've just evaluated now. 4, another year 6, another year 8. So those are fluctuating different cash flows, use PV. But if, for example, you invest in a project like Project X, you're putting in 15 today, then it gives you year 1, 6, year 2, 6, year 3, 6. The cash flows are constant. There are annuities. They are uniform. Then you use PVFA. Use PVFA. Maybe you could revisit this small video that you must have done with Mwalimu where he was explaining when to use this PVFA and PVF. That could really be important. And then somebody is asking, how do we estimate cash flows in real life? It's very easy. You can even do this at your workplace. Yeah, very easy. What do? You have your PAT. Yeah, for example, 2015, 2016, 2017, blah, 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 blah. So you have your PAT, maybe it was 10, 20, 30. So then to get cash flows from profit after tax, please add back any non-cash items. So in most cases, you add depreciation. Yeah, so you have 1, maybe 2. So in this case, then you'll be able to get your cash flows. Yeah, 11, 22, 33, etc. Now these cash flows, of course, now you'd want to project them in the future. Now in financial modeling, you can assume, for example, they'll be growing at say 10%, and then you'll be able to estimate. Be able to estimate. Fortunately, you'll be doing that in your business data analytics next year. Yeah, next time when you pass this round 1, next time, which will be business data analytics. Yeah, it's examinable. You know, CASNEB can examine you, yeah, in anything. Yeah, and so long as you are able to get, in this case here, the formula of Radri, which is very similar to CAPM, then you'll be good to go. It's given by the examiner, yeah. The 2 formulas for that. 2 formulas. 2 formulas. Why 2 formulas? Remember, they are not like 2 formulas. I was just trying to explain that Radri borrows quite a lot from CAPM. If you remember CAPM returns, we have risk-free plus ERM minus risk-free multiplied by beta of the security. And if you remember Radri, it will be risk-free plus, you can also talk of core minus risk-free. You can even bring this here. You still get the same answers. It's not like there are 2 formulas. You just have to know that they are a little bit similar. So if you go to an exam and maybe the examiner has not given you the Radri formula, you'll be able to remember something. Yeah, you'll be able to remember something like that. So please allow me to go to decision trees, so you can at least make some headways. So decision trees, these are very, very popular. And students fear them for nothing. I've never feared them myself, never. Yeah, so decision trees, we are told that a decision tree is a graphical representation of decisions and the possible outcomes. Yeah, you've made a decision to pursue, in this case, your CPA. When you do your exam, there are 2 possible outcomes. So when you capture that decision-making process, yeah, graphically, then automatically you are drawing a decision tree, showing probabilities and the payoffs. The purpose, it breaks down complex sequential decisions. Advantages, it considers multiple stages. It explicitly incorporates probabilities. Disadvantages, it can be complex with many branches. So straight away, let's tackle a past paper question. Let's tackle a past paper question. Alfred, yeah, please just follow what we are doing. Don't worry. It doesn't have to be, even the one that I'm doing here is CASNEB question. It doesn't have to be. Just follow what the Chief Ninja is doing. Follow the Chief Ninja, what the Chief Ninja is doing. All right. So please give me just 1 minute. 1 minute. 1 minute. Right. So there's a past paper that I'm looking for here. 1 minute. Just want to get one intensive, great question on these nation trees. Remember, this can be tested in AFM or AMA. All right. So as I get this question, which I'll be getting in a few minutes, ladies and gentlemen. Yeah. So what normally happens, please listen and listen to me very well. You will be given this kind of a structure. They will tell you, in this case here, there are two possibilities. Yeah. So in this case, you're investing. When you invest, in this case here, there is year one. So year one, in this case here, you could either get 6, a cash flow of 6, or a cash flow of 7. With this probability is 0.4 and 0.6. First, we understand this, 0.4 and 0.6. Yeah. And then after year one, we go to these other years moving forward. So we have here years 2 to year 6. You get in this case here, for example, 4, and in this case here, 7. Yeah. Here, for example, you get here, also let's work with the same, 4, 7. So here we have 0.8, 0.2, 0.8, 0.2. All right. And then you are given additional information. You are given additional information. Number 1, you are told initial outlay is 10. Yeah, but that's quite low. Let's talk of initial outlay of 25. Yeah, because that for, yeah, yeah, 25. Yeah. And then you are told in this case here, number 2, ladies and gentlemen, that the cost of capital is 10%. Cost of capital is 10%. So you are required here to use decision tree. Required, use decision tree, yeah, to advise the client. To advise the client. To advise the client. Use decision tree to advise the client. So let me know once you are able to draw this, the way I've just been able to capture it here. So remember, year 1, there are 2 possibilities. We either get a cash flow of 6 or a cash flow of 7. And then we have years 2 to year 6. Years 2 to year 6, we start enjoying things there. So please, once you finish drawing this, mention there Y for yes. Mention there Y for yes. Great. Thank you very much. So I read here additional information. The initial outlay is 25. Cost of capital is 10%. Cost of capital is 10%. So they want us to use decision tree to advise. Now, ladies and gentlemen, please listen and listen to me very well. So then, if you have been able to finish drawing this, I'll also take a screenshot of this. And then I will do this question together. Great. So now we are using decision tree. Let's use decision tree, very easy. So remember that a decision tree will have a box and a circle node. So the symbols we use. So we have a box. So this is a decision alternatives node. Yeah. And then we have a circle, the outcomes node for probabilistic events. For probabilistic events. Probabilistic events like that. So these are the only 2 symbols that we shall always be using whenever we are looking at a decision tree. So we have decision alternatives node, and then we have outcomes node. This one, no probabilities. Yeah, no probabilities. All events without probabilities shall always come from this node. Now, ladies and gentlemen, with your permission, then I will be able to draw now my tree. I'll be able to draw my tree. We take a break, a break of a break. Yeah, 5 minutes. Is that good enough? 5 minutes. We come back at 9:13. 9:13. 5 minutes here, please. Very important. This is an important area. Take a break. Can we continue now? Are we back? 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 Thank you so much. Now, please listen. We are saying here that whenever you see this box, automatically it is for the decision alternatives for those events without probabilities. A circle is an outcomes node for the probabilistic events. So this being a financial management capital budgeting question, we shall always start by making a decision. We take a decision and we are deciding between, do we invest because it's capital investment, or in this case here, do we make a decision not to invest, don't invest? If we don't invest, we expect to get a zero. If we don't invest, we expect to get a zero. We expect to get a zero. And if we invest, what do we expect to get? If we invest, there are outcomes, and those outcomes are probabilistic. If we invest, there are two possible outcomes for the year one cash flows. So year one cash flows, is there somebody who can remember? Year one cash flows, anybody who is able to remember the cash flows? Those are outcomes of investing. Those are outcomes of investing. So year one cash flows, we could either get 6 or what here somebody? 7. With probabilities of 0.4, and then we have here what here? 6. Remember we said a circle, we shall always have probabilistic events coming out of them. It doesn't stop there. We still have other outcomes. So come here, ladies and gentlemen, and go to year 2. So year 2, there are also 2 possibilities. So year 2, we could either, so for year 2 to 6, we could either, ladies and gentlemen, in this case here, get these 2 cash flows. These 2 cash flows, there are 2 possibilities. We could either get 4 or what here, somebody? 4 or 6. That is year 2. Yeah, 4 or 6. No, 4, 7, sorry. 4, 7. 4, 7, like that. With what probabilities? 0.8, 0.2. 0.8, 0.2. And that is it. So let me know whether, ladies and gentlemen, you've been able to know how to, or rather you've been able to finish writing up to here. So the good thing with AFM, we shall always decide, we shall always start from, do we invest or do we go without investing? If we go without investing, it's 0. If we invest, then we wait for some probabilistic outcomes. So I would want to know whether you guys have been able to draw up to where Mwalimu has reached. I would want to know whether you've been able to draw up to where Mwalimu has reached. Yes, they're saying yes. Thank you. They're saying yes. Thank you so much. Now, ladies and gentlemen, please do me a favor. Do me a favor. Whenever it comes to decision trees, the first thing you need to do is to draw. Step number 1, you draw the decision tree. Draw decision tree. That's step number 1. Step number 2, give us discounting factors. Give us discounting factors. So for example, I can see end of year 1, I expect to get a cash flow. So end of year 1. So in this case here, we have here PVF. Yeah, 1. Are you able to give me that discounted cash flow? Remember, this is 10%. Remember, this is 10%. 10% is in your table. 10% is in your table. 10%. Oh, not yet. They haven't finished, eh? They haven't finished. These ninjas haven't yet finished. These ninjas haven't yet finished. So we have here 10% PVF. Yeah, present value for end of year 1 is 1991. 1991. Ah, yeah. Now please listen. and listen to me very well. How about this? How do you interpret this? From years 2 to, pardon, yeah, okay. From years 2 to year 6, how do you interpret that? It's PVFA. It is PVFA. Because I'll be getting those cash flows every year from years 2 to years 6. Thank you so much. Marvin has been able to know actually. So in this case here, we want to get PVFA. We want to get PVFA. Yeah, 2 to 6. So Marvin is telling me, Mwalimu, this one, you have to expand it. How do we expand this? I will say it is PVFA 6. Yeah. So the first 6 years, 1, 2, 3, up to 6. But you see, they don't want 1 to 6. They want 2 to 6. So there is an unwanted. Unwanted in this case here will be PVFA 1. So people will come and subtract here PVFA 1. Please listen. When you see in this case here in a situation where they are giving you PVFA 9 to 17. So don't write this. Just help me expand this. PVFA 9 to 17. It will be PVFA what here, somebody? 17 minus PVFA what here, somebody? Yeah, number of years minus PVFA 8. Because you can see they want from years 9 to 17. They want from years 9 to 17. All right. And yet when I say PVFA 17, I've taken 1, 2, 3, all the way up to 17. And yet there are unwanted ones now in this. So I need to come and see what has been cut out. So what has been cut out is PVFA 8. PVFA 8. Now please listen. How do we get the years? Remember the years were given in the question, eh? The years were given in the question. So do we have PVFA 6? Do we have PVFA 6? 10%. Remember the cost of sample is 10%? Oh, yes. Yeah. You go to the annuity table. So in the annuity table, you can see the PVFA 10%. In this case here, 6 years. 10%, 6 years. It is here 4.8684. 4.8684. Minus PVFA 1. So PVFA 1, ladies and gentlemen, for 10% is 0.9091. 0.9091. Yeah. The other alternative is that you calculate them using the formula. Using the formula. So can somebody give me this difference? PVFA 6 minus PVFA 1. What do we have there? Yeah, according to JD, we are getting 3.4463. 3.4463. Yeah. So somebody wanted to, pardon, I don't know whether they wanted me to draw the whole tree from scratch, or I can just finish, and then perhaps I release the ones who have understood, and then I repeat the whole question. I think that would be fair. So I can see the students who are following. Yeah, I can just take 5 minutes. I just finish. I send those guys. Point two, discounting factors. Discounting factors. Yeah, the PVFA and the PVFA. Discounting factors, remember these are the PVFs and PVFA. So number 1, you draw the lesson tree. Number 2, you give us discounting factors. Number 3, you give us net present value. So go to number 3. Give us net present value. Number 3, net present value. Thus, ignore all probabilities. Ignore all probabilities. As you get this net present value, you ignore all probabilities. 3.95. Somebody is telling me it's 395, 93, yeah? 3.95. Be careful. 3.95, 93. Be careful. Thank you so much. Be careful. So then for us to get these NPVs, come and give this is number 1, number 2, number 3, number 4. So you label all your branches. Label all your branches like that. Label all your branches like that. And then now you give us NPV for each branch. So we start with NPV for each branch. So we start with the branch 1. So branch 1. So branch 1. So branch 1, remember, if first of all I'm to invest, is there somebody who is able to remember the initial outlay given the question? Anybody who is able to remember the initial outlay? 25. So if we invest, we are going to enjoy 25. Not enjoy, but we're going to pay. So it's a cash outflow. So branch 1, you assume like you are a Subaru driver. A Subaru driver, and you're going in this case here through your branches. You're going through your branches, you're going through your road. Yeah, from the very beginning, through your road. Yeah, you pick only cash flows. You pick only cash flows for road number 1. So road number 1, I can see I have the initial outlay 25 plus. Here I can see a cash outflow, a cash inflow 6, but it's coming at the end of year 1. So if it's coming at the end of year 1, I must multiply this with the PV, which was 0.9091. This 6 is coming at the end of year 1. Then I continue as Subaru driver. This is my road 1. So my road 1, I can see that I have got this 4. So this 4, I'm going to multiply it with PVFA because it is from year 2 to year 6. And this PVFA, you guys have given me 3.95, 93. 3.95, 93. Yeah, present value interest factor of an annuity, 6 years. Just give me a few minutes. I finish these branches very fast, and then I start the question from scratch. For the students who would not have followed, I started from scratch. Are we using PV for 7 years? I haven't used for 7. Do you use for 7 or 6? Do you use for 7 or 6? If you use for 7, you are wrong. It's supposed to be 6. It's supposed to be 6 years. It's supposed to be 6 years. Or 6 is wrong. Is it the table which is wrong? The one that I was reading. PVFA 10%. Oh, this is 7, eh? This is 5. 86. I think the figure of mine is misleading me. So for 6 years, it's supposed to be equal to what? Can somebody give me this figure? 6 years is supposed to be equal to what? 4.3553. I'm being given here 4.3553. Sorry for that. 4.3553. Yeah. So I hope this will change as well. This must change. We can use the formula to reach 3.462. Thank you for that. Then, so we have here, so this is 3.44, 62. 3.4462 like that. So then can you kindly go ahead and give me the branch 1, NPV for branch 1. NPV for branch 1, it will be minus 25 plus 6 times 0.9091 plus 4 times 3.4462. NPV for branch 1. Somebody who already has that figure. So I'm being given here minus 5.7606. Like that. So is there somebody who can try NPV for branch 2? Just try. Maybe you don't get it right. So what? For branch 2. Just move around like a Subaru driver. Targeting branch 2 now. Targeting branch 2. What do we have there? Just try branch 2. What do we have over there? So according to Margaret, she's gotten 4.578. Let's do it together. Let's do this together. Branch 2. Let's do branch 2 together. So branch 2, ladies and gentlemen, this is what we are doing, branch 2. You pick the cash flows as you go. So invest today will never be discounted. That's minus 25. Plus, the next cash flow is coming here for branch 2. 6 times 0.9091. For branch 2, I can see the next. So you see I'm moving like this. This is the road for branch 2. The next one is 7 coming from this to this. So plus 7 times 3.4462. What do we have there? Somebody. Marvin has also been able to get 4.578. Is that okay? So can you now try yourself, branch 3? Give me NPV for branch 3. Just try, be proactive. Just try. Just try. Branch 3. Branch 3. So remember, we are moving. This is our road. So branch 3, I can see branch 3. So I'm seeing this minus 25 plus, I'm seeing this 7. So 7, ignore the probabilities. I know this coming at the end of year 1. PV is 1991. Plus, ladies and gentlemen, here I can see 4. So 4 times this 3.4462, which will end up giving me what figure for branch number 3. I'm being given minus 4.8515. Like that. And then now we go to branch number 4. We go to branch number 4. Just try. Branch number 4, we have Margaret 5.4871. 5.4871. I can do it. Let me do it. Branch number 4. So branch number 4, what do we have? So for branch number 4, ladies and gentlemen, I can see how the, so it will be minus 25 plus 7 times pointer 9091 plus this 7 times 3.4462. Is there somebody who can confirm that figure is correct? Anybody who can confirm that figure is correct? Anybody who can now try and confirm that that figure is correct? So step number 3, give us NPV for the branches, ignoring the probabilities. Correct. The second last step. I think it's step number 4 now, before I start repeating this. So step number 4, ladies and gentlemen, go ahead and give us the joint probabilities. Give us joint probabilities for each branch. For each branch. So remember again, you are following your branches. You're following your roads. We start with road number 1. So road number 1, only probabilities. So road number 1, you can see we have 2 probabilities. 0.4 and 0.8. So we have here 0.4 and 0.8. Remember, a joint probability is an AND probability. You're multiplying. You're multiplying. You're multiplying. And the probability. So come and write here JP. JP for joint probability. So I'm being given 0.32. 0.4 times 0.8. How about branch number 2? Is there anybody who can give me the JP for branch 2? JP for branch 2. So for branch 2, you can see here there is no probability. Here there is a probability. Here there is a probability. So it will be 0.4 times 0.2. Can somebody give me this figure? 0.08. You write like that. So 0.08. 0.08. Then we go to branch number 3. So branch number 3, what do we have in branch number 3? So branch number 3. Somebody please talk to me. Talk to me. So branch number 3, I can see my branches here. 0.6 times 0.8, which will end up giving us one figure 0.48. Thank you so much. 0.48. And then we come to the last branch, which will be 0.6 times 0. So number 4, 0.6 times 0.2, which will end up giving us what figure? 0.12. Thank you so much. Remember, JP, total probability must be 1. JP, total probability must always be 1 if you add all of them. If you add all of them, it must always be 1. JP must always be 1. So the last step, you give us the expected net present value. Yeah, give us the last step. I don't know whether it's number 5. Give us the expected net present value. So remember, this is the net present value. So create a column. Create a column by the side there. Create a column by the side there. Create a column by the side here. Yeah. And they give us NPV times probability. 2 decimal places. NPV times probability. Decimal places. So we have this minus times this. Give me 2 decimal places here. I write. Minus 5.7606 times 0.32. 2 decimal places I write, my good students. Oh, they're not talking to me now. They're not talking to me now. They are not talking to me now. Minus 1.84. So minus 1.84. Then you continue like that. Go to the second node here. We have this NPV times 0.08. Give me an answer. 4.578 times 0.08. Give me an answer. 0.37. Thank you so much. 2 decimal places are sufficient. Then we have minus 4.8515 times 0.48. So minus 2.33 minus 2.33. Thank you very much. And then the last one is 5.4871 times 0.12. 0.66. So now remember, you need to come and add all of them. Once they are discounted, you have incorporated risks, you have incorporated probabilities, you add all of them. You add all of them. Add all of them. If positive, you compare to 0 and accept the project. If negative, I would rather not invest and get 0. So according to Marvin, he's getting negative 3.14. And this is the expected net present value. Expected net present value is minus 3.14. The project is not viable. The project, because of negativity, the project is not viable. The project is not viable. So then now I can address your questions. You guys had very good questions when you started. For example, somebody was asking about this PVFA. Yeah, so now the class is over, but there are questions that I would want to address. So somebody was asking about this PVFA. Maybe I could just repeat this very fast. Yeah, quite a high probability you're right. Negatives. Probability of making a loss. This ninja is very good. Probability of making a loss is 2/4, which is a half. So remember, the formula for PVF is 1 plus R raised to negative N. The formula for PVFA is 1 minus this. Yeah, all over R. So then this one here will be 1 minus, we have here 1 plus 0.1 raised to, remember here they were 2 to 6. So first of all, we did 6, the higher one. Yeah, so raised to 6, divide this by R, which is 0.1. Can someone in this case here give me this answer as we disappear? Yeah, the last column, it's NPV times probability. Must see the last column is NPV times probability. NPV times probability. XP column. Okay. So then what I would suggest, ladies and gentlemen, if possible, you can watch this video. And then, of course, when I come now in my next class, I should be able to even start this concept from the very beginning, but ensure that you have watched today's video, because lesson 3 rarely misses. It rarely misses. This is really important for all of us. All right. Sorry, I've really shouted. I never wanted to shout like this. When I shout like this, it will affect my performance tomorrow. So I beg to disappear. I beg to disappear. We shall overcome. I share the handout. Yes, the handout I'm sharing now. Let me share the handout now so that you can give it on WhatsApp. I'm sharing it here so that you can now, in this case here, share it with everybody. Great. Thank you, Sain. You are overcoming. We are overcoming. So AFM, most of you have this handout, eh? Most of you have this handout, but just confirm you have seen it and share it. Somebody download it and then you share it. Once you download it, please let me know so that I can close the meeting. Seen. Thank you so much. So, and once you download it, Marvin, that's when you tell me now, Mwalim, close the meeting. We close the meeting. We close the meeting. Once you download it in your machine, can I know? Thank you so much. Shared on WhatsApp. Maslin, thank you so much. Bye. There is somebody saying he had a challenge in watching the videos. Perhaps I'll give you a number of a student. I mean, someone will be able to guide you. Yeah, in your class, I'll be able to give you a number of someone will be able to guide you immediately. All right, done. Yeah, tulale salama sasa.